When buying a financial asset, an investor gets a return over time, with a path that might be more or less bumpy. It is usually difficult to precisely know the return over the next few quarters, but over the long term, it is possible to get a good idea of the expected returns depending on the risk of the asset class. To smooth the return profile, it is advised to combine different types of assets so that when some asset classes suffer, others are doing well and, in the end, investors can reach their return target. It is a bit like an engine with 8 cylinders. It works more smoothly than an engine with 3 cylinders only. But there are many ways to combine assets in order to get attractive returns with a smooth return profile. At Lombardier, we have tried and tested most of them over the past 225 years. Today, we are convinced that the best way to allocate assets is by maintaining a stable risk profile at the portfolio level, as well as stable contribution from each underlying asset class to the overall risk. Let us see how it works. First, we define the risk profile of the portfolio. For example, for a so-called balanced profile aiming to deliver 4 to 5% annual return over the current key rates of central banks, we will define a risk budget of 10%, meaning that we aim to limit drawdowns over a 12-month period to below 10%. Once the risk budget is defined, we diversify the sources of risk to smooth out the sensitivity of the portfolio to the economic cycle. We invest globally in both developed and emerging markets in a broad range of liquid asset classes, including equities, commodities, government bonds, corporate credit, and cash. Liquidity is key to manage drawdowns and keep them within predefined limits. Once the portfolio is built, the allocation to each underlying asset class is actively managed depending on the respective risk evolution. A bit like a sailboat, when the wind is blowing harder, one might lower the sails in order to ensure smooth navigation. As an example, in 2020, the equity exposure of our balanced profile has fluctuated between 4% and 34% of the portfolio. A flexible allocation is indeed key to navigate through cycles. On top of this, our proprietary dynamic drawdown management system helps protect the portfolio against extreme losses during market crisis or when all asset classes are falling at the same time.
There are major benefits to include such a total return strategy in your portfolio. First, it is systematically managed, meaning that the execution is done in a very disciplined way. History has shown that managing one's portfolio and managing one's emotions are two different things. Even for the most skilled investors, we are convinced that it is key to have some systematic strategies alongside more traditional approaches. It is the best protection against oneself. The second benefit is the global exposure to all kinds of liquid assets. It diversifies further an existing portfolio and helps capture growth in any sector or any country in the world. Lastly, there is no bad surprise with this strategy. You know in advance the risk you're taking, and it is completely liquid. We want to sleep well at night and want our investors to do too. As for all investment products, performance is key. This all-road strategy has been managed for more than 10 years, first for our own pension fund, and then gradually for institutional clients and private clients. For all of them, it is our flagship strategy for risk-based multi-asset. And as a result, about $10 billion are managed under this strategy today. The 4 risk profiles that we manage have delivered attractive returns with very low drawdowns compared to traditional balanced strategies. All roads suits clients with an investment horizon of at least 3 years who would like to significantly outperform their money market funds or bank deposits while taking reasonable risks. Thank you for watching.